Hello teacher, my name is Dinh Thanh, and today I'm going to present you about the lecture, the chapter 5 in the bank management. In this chapter, I have divided from two main topics. First is about the financial statement, and the second is provision for possible loan loss. We can call it PLL. Okay, let's start about the financial statement. In the financial statement, I divide it from two parts. First, we'll about the report of condition, or we can call it balance sheet. The second is report income, or we can call it income statement. Let's begin with the report condition balance sheet. In balance sheet, we have the principal. Here is assets and liabilities and equity. We can have a relationship of them. Here is the equation. Here is asset equal liabilities plus equity. In asset, we can see that we have four parts. The first is cash involved and deposits held at other depository instructions. We can call it C. The second is securities purchased on the open market. We can call it S. The third is loan and lease financing made available to customer. We can call it L. And the last is and the last here is miscellaneous assets. We can call it MA. In each part, we have, for example, in the securities purchased on the open market, we have short-term government securities. The second, privately issued money market securities, investment securities, and trading account assets. Especially in investment securities, we have more about, for example, income generating portion of securities. The second, taxable securities. The third, tax-exempt securities. In taxable securities, we have U.S. government notes, government agency securities, and corporate bonds. And in tax-exempt securities, we have municipal bonds. In trading account assets, we have securities purchased to provide short-term profits from short-term price movement. And when the bank acts as a securities dealer and is valued at market. Move to the loan and lease financing. We have loan accounts and types of loans. In loan accounts, we have the federal funds, sales and reserve repurchase agreements. From it, we can have three parts. Each January overnight loans, federal funds, sales funds come from the deposits at the Federal Reserve. Reserve repurchase agreements, bank takes temporary title to securities owned by borrower. And we have gross loans, sum of all loans, allowance for possible loan loss. In allowance for possible loan loss, we have a control access account, and for potential future loan loss. Moreover, we have the net loan, unearned discount income, non-performing loans, commercial and industrial loans, consumer loans to individual, real estate loans, financial institution loans, foreign loans, agricultural production loans, security loans, and lease. Move to the miscellaneous assets. We have three parts: bank, premise, and fixed assets. Other real estate owned, and goodwill and other intangibles. In deposits made by and owed to various customers, we have the deposit account 70 to 80%. From this, we have the non-interest bearing demand deposits, saving deposits, now accounts, money market deposits accounts. We can call it MMDA, and the time deposits. In non-deposit borrowing funds in the money and capital markets, we call it NDP. We have the Fed funds purchased securities sold under agreement to repurchase. We call it repurchase agreement. Acceptance outstanding, euro currency borrowings, subordinated debt, limited life preferred stock, and others liabilities. And in equity, we have the long-term funds. The owners contribute to EC. We have the two types of stock. Is the preferred stock and common stock. In the common stock, we have the common stock outstanding, capital surplus, retained earnings, undivided profits, treasury stock, and contingency reserve. And here we have the relationship of here is C plus S plus L plus MA equal D plus ND P plus EC. Now move to the second report. Here is a report of income statement. In income statement, we have the net interest income, expenses. We can have the equation of this is net interest income equal interest income minus interest expense. In the interest income, we have the interest and fees on loans, taxable securities revenue, tax exempt securities revenue, and other interest income. And in interest expense, we have the deposit interest cost, interest on short-term debt, and interest on long-term debt. Moreover, we have net non-interest income, non-interest expense. We have the equation can describe this relationship is net non-interest income equal non-interest income minus non-interest expense. In non-interest income, we have the fees earned from fiduciary trust activities, service charges on deposit accounts, trading account, gains and fees, additional non-interest income. In non-interest expense, we have the wage, salaries, and employee benefits, premise and equipment expense, other operating expense. We have more is fees earned from fiduciary activity, fees on monitoring, protecting a customer property, fees for record keeping for corporate security transaction and dispensing interest and dividend payments, fees for monitoring corporate and individual pension and retirement plans, In the service charge on deposit accounts, we have the checking accounts, maintenance fees, checking account overdraft fees, fees for writing excessive checks, savings account overdraft fees, fees for stopping payment of checks. And in trading account gain and fees, we have a net gains and loss from trading costs, interest instrument, and of balance sheet derivative contracts that have been recognized during the accounting period. In additional non-interest income, we have the investment banking, advisory, brokerage and underwriting, venture capital revenue, net servicing fees, net securitization income, insurance commission fees and income, net gains or loss on sales of loan, net gains or loss on sales of real estate, and net gains lost on the sales of other assets. And we have the symbolized income statement. Here is the picture, and we can have the equation. You can see the equation in here is interest income minus interest expense equal interest income. Okay, you can hear, and after net interest income minus provision for loan and lease, non-cash outflow, plus non-interest income minus non-interest expense equal pre-tax net operating income plus or minus securities gains or lose minus income tax minus income before extraordinary items equal net income, and minus dividend and equal returning profit. It's mean profit. Okay, now move to the last part. Here is the provision for possible loans and loss with COVID PLL. We have three things to say about this. We have the experience method over the last 6 years, specific trust of method, and the last year allowance for loan and lose. Here is a picture. You can easily see the equation. Here is beginning of plus provision for loan and loss income statement equal adjusted allowance for loan and lose minus actual charge off plus recovers from previous charge offs equal the ending allowance for loan and lose. And here is my mark for summarize all of the knowledge that we need to know in this chapter 5. Thank you for listening, and goodbye.